A Dubai property held for 5 to 7 years can deliver 60 to 100% total returns completely tax-free. But timing your exit wrong could cost you 15 to 20% of those gains. Today, we're giving you the complete exit strategy framework for 2026.
Welcome to Dubai Daily, your essential morning briefing on Dubai's real estate market, with insights from Parag Kundalwal, founder and CEO of Consultaa. I'm Lily.
And I'm Daniel. Today we're covering the crucial topic of exit strategies, when to sell, how to maximize those incredible tax-free gains, and the best wealth preservation tactics for the 2026 market.
Let's start with the big question, Daniel. How long should an investor hold a property? Is there a magic number?
The general rule of thumb for residential property is a 5 to 7 year holding period. This allows you to ride a significant portion of a market cycle, but it really depends on your initial strategy.
Right. You have your short-term flippers, aiming for a 2 to 3 year exit. They buy off-plan and sell just before completion, often capturing a quick 15 to 25% gain.
Then there's the medium-term hold of 3 to 5 years. This is where you see the project through to completion, benefit from the initial rental yield, and sell as the community matures.
And for long-term wealth preservation, we're talking 7 to 10 years or more. This is about capturing the full cycle appreciation and letting that rental income compound. For villas and luxury properties, that 7 to 10 year plus time frame is even more critical.
Exactly. And for our 2026 context, market data suggests that the optimal exit window for mid-market apartments is Q1 to Q2 of 2026, right before a projected supply peak in the second half of the year.
So timing is everything. What are the specific signals investors should be watching for to know it's time to sell?
On a macro level, you watch for market cycle indicators. Are prices starting to plateau after a strong run? Are rental yields compressing? That's a classic signal. For instance, if yields in Jumeirah Village Circle or Business Bay start dipping below 6%, that's a trigger to evaluate an exit.
And then there are the property-specific triggers. These are often positive signals. The completion of major infrastructure like the Metro Blue Line or the expansion of Al Maktoum Airport can add a significant premium to nearby properties. You want to time your exit to capture that value.
Let's not forget personal financial goals. It might be about rebalancing your portfolio, needing liquidity, or deciding to cash out and compound those tax-free gains into a new investment.
Conversely, stronghold signals would be ongoing infrastructure projects, continued scarcity in the luxury segment, or simply having a high-performing rental asset that consistently outperforms other investment alternatives.
Which brings us to the most powerful advantage Dubai offers: maximizing tax-free capital gains. This is a game changer.
It truly is. Dubai has zero capital gains tax. Compare that to London at 28%, Mumbai at 20%, or New York City at nearly 24%. It's an enormous difference.
Let's put that into numbers. You buy a property for 3 million dirhams and sell it for 5 million. That 2 million dirham profit is entirely yours, tax-free. In London, that same profit would net you a tax bill of over 560,000 dirhams.
That's staggering. And it creates a powerful compounding advantage. You can reinvest the full gain into your next property without any tax erosion. Over a decade, this can create a 40 to 50% wealth multiplier compared to investing in high-tax jurisdictions.
Plus, there's no minimum holding period requirement to get this benefit, unlike the US 1031 exchange. And with zero inheritance tax, it's a phenomenal tool for estate planning.
So once you've made that gain, what are the best strategies to preserve and grow that wealth?
The most common is strategy 1: sell and reinvest. This is classic portfolio rebalancing. For 2026, this could mean exiting a mid-market apartment in an area with high supply, like JVC, and reinvesting into a luxury villa on Palm Jumeirah, or a property linked to new infrastructure.
Strategy 2 is to hold and refinance. If you have significant equity built up, you can refinance to extract cash at a favorable rate and use those proceeds for your next purchase, all while your original asset continues to appreciate and generate rental income.
You also have partial exits for diversification, maybe selling one of two properties to invest internationally, or simply optimizing your portfolio for long-term rental income, focusing purely on cash flow.
Good advice. Diversification isn't just about assets, but also location and developer. Spreading your holdings across 3 to 5 communities and focusing on Tier 1 developers like Emaar, Nakheel, and Maras significantly reduces risk.
Let's talk tactics for the actual sale. How do you execute a successful resale?
Preparation is key. Professional staging and photography are non-negotiable. They can deliver a 300 to 500% return on investment by attracting better offers faster. And make sure any minor repairs are done beforehand.
And be strategic with your timing. Q1 often sees a surge of corporate relocations, which can create a 5 to 10% price premium. Q4 is also strong with year-end buyers. Try to avoid the summer slump from June to August if you can.
Remember to factor in transaction costs. The 4% DLD transfer fee is typically split between buyer and seller, plus a 2% agent commission and minor NOC fees. This needs to be built into your profit calculation.
Okay, Lily, let's put it all together. Give us the rapid-fire 2026 Market-Specific Exit Playbook.
Let's do it. For mid-market apartments in JVC, Business Bay, or Arjun, look to exit in Q1 or Q2 2026 before that supply hits. For luxury properties in Palm Jumeirah or Dubai Hills, hold through the cycle. There's minimal correction risk and strong appreciation potential.
For properties near new infrastructure like Dubai South or the Metro Blue Line corridor, hold for another 3 to 5 years to capture the full 15 to 25% infrastructure premium.
If you're holding an off-plan unit nearing completion, flip it before handover for a potential 15 to 20% gain if the market is strong. If yields look more attractive, take possession and rent it out.
And a crucial one, if your property is linked to your golden visa, plan your exit around the visa renewal cycle. A premature sale could jeopardize your residency.
So, let's recap the key takeaways from today.
The optimal holding period is generally 5 to 7 years for residential, but your strategy dictates the timeline. For a 2026 exit, Q1 and Q2 are the prime window for mid-market apartments to get ahead of the supply peak.
Leverage Dubai's zero capital gains tax. It's a massive wealth multiplier. And preserve that wealth by rebalancing from oversupplied areas into luxury or infrastructure-linked properties with Tier 1 developers.
That's your complete exit strategy framework for Dubai 2026. Whether you're planning a strategic exit, portfolio rebalancing, or long-term wealth preservation, timing and tax efficiency are everything.
For personalized exit strategy planning and portfolio optimization, contact Parag Kundalwal, founder and CEO of Consultaa. You can reach him on LinkedIn at Parag Kundalwal. Visit consultadxb.com, that's consultadxb.com. Email Parag at consultadxb.com or call +971 58 596 4631.
Dubai Daily, airs Monday to Friday at 7 a.m. Dubai time. Subscribe for your daily dose of market intelligence. I'm Daniel.
And I'm Lily. See you tomorrow.